Gary and John are both longtime members. They're going to talk about making money through passive investing through multifamily syndication. If you don't know what syndication is, you're in the right place because they will explain it to you. Gentlemen.
Thanks, Andy.
You got it.
Hi, everybody. I'm Gary. This is John.
How you doing?
So,
A lot of faces I don't recognize, so it's good.
yeah. Let's see. We're just going to talk a little bit about passive investing and through multifamily syndication. So, I guess a little bit of background on us. John and I actually met through this FFREIA group back in 2019, and we've been through a syndication mentorship program. Michael Blank, you may have heard of him. He was a speaker once on Bigger Pockets, where I was introduced to the concept as well as John. We didn't know each other at the time. Myself, I've been investing in real estate for 20-some plus years. I've got several duplexes and triplexes I've bought and sold, and was looking to get into something bigger. That was my introduction to getting into multifamily, larger apartment complexes. And I ended up listening to Bigger Pockets and tuning into Michael Blank, who's a syndicator, which we'll talk about what that's all about and how we got into it. And John?
Yeah, it's interesting because Gary talks, it's the same story I have than his, because we followed each other the same path at the same time, but didn't know each other at the point we were doing it. And when we kind of came together, we both got the same training, and we're both kind of like hungry to go into multifamily, large properties. And the interesting part about all this, just to bring up the room in here, we both did single families, doubles, triples. Gary got in much earlier than I did. I probably was into the business for about 7-8 years. And when I found out about this, it kind of opened my eyes that there's another way of doing what we do, but at a different level. And it made sense to me once I saw how everything worked. And my point is to everybody here that if you want to grow and do something bigger, don't be afraid to do it. I mean, if I went back 10, 12 years ago, I didn't even own a home, a residential, a property, besides my own home. So it's a matter of you being interested in something like this, learning more about it, either being an investor in it, a passive investor, or possibly be involved in syndications yourself like we are. So just kind of putting that out there to you. It's not that hard. It's a recipe. You put it together and you kind of apply yourself. So it's like anything else we do. So I think that's about it. I want to point out. I'll go in here and start. Next slide for you, Gary, if you want to go into this.
Yeah, so everyone understand the difference between active and passive investing? Active, and it's not one or the other, right? Because I'm still I'm an active investor as well as a passive investor myself. I invest passively in other syndications. I've been doing that for several years as another revenue stream. If you have extra cash or the funds that you want to invest, it's a great way to go, as opposed to the stock market. I'm also involved in the stock market, but it's just another lever, another income stream. Active investing, you're putting in your own material, your own sweat, your own hard work to maybe you've got a single family, a duplex, or whatever you're investing in, and you're putting in your own effort, painting the walls. As a passive investor, you're investing your capital, but you're not really involved in the day-to-day management of the property. It's more for a revenue stream, another way to think of it as an alternative to maybe the stock market. I enjoy it. I've made I would say very good returns doing it, actively, passively investing, and our business model supports including passive investors in what we do, and that's multifamily syndication.
So we're going to go over a few things here. Our agenda today is just going to be what is multifamily syndication, why multifamily, and how to invest in multifamily syndication. Then at the end, if we have time, we'll do a syndication example deal that we have, a property that we actually purchased, so we can kind of show you what we were looking at up front. Just kind of give you an idea how it works. So what is multifamily syndication? You want to start off with this, Gary? Or you want me to go?
Yeah, so basically it's pooling of other people's money, right, to buy a larger piece of property. It doesn't have to be an apartment building. People syndicate all kinds of things. John and I have been at conferences. We've gone to Michael Blank's conferences, Joe Fairless. We've traveled around the country. We've actually seen people syndicate parking lots.
Yeah.
Oddly enough, crazy enough, but syndication is just many people coming together, because to buy these large apartment buildings are multi-millions of dollars. Not all of us have that kind of money, and so we pool our money together and buy it kind of, we're partners in the deal. We actually have an operating agreement, it's a business model, it's all legal, and that's how we kind of get into it. So it's supposed to be a picture of people all putting the money in.
Is this a syndicated, the Tip Hill properties?
It is, yeah. Yep, we've syndicated a couple properties, and we have investors. Some are in this room tonight, and by doing this, basically we everyone kind of shares in the profits, right? So it's just the way that we'll kind of describe how that all comes out, but. The syndicated is typically formed by an experienced real estate syndicator or sponsor. Doesn't have to be, but in this case here, John and I partnered up to become the syndicators. The larger the deal, you may end up taking on other, syndicators or other sponsors to come in. There's lots of things to do in this type of business. There's managing the asset. Everything from the beginning would be, raising the money, working with the banks, finding the deal, a lot of different components to it there. But that's basically what it is. You have a sponsor who basically finds the deals, manages the property, and oversees the overall investment.
So going back to what we talked about the sponsoring, Gary. So the sponsors involved is responsible for investing in the equity, including scouting out the property, raising funds, acquiring and managing the investment, property day-to-day routine. So basically doing all the hard work, the stuff that comes with the property, which can be extensive if you don't have good property management. When you manage a property manager, there's different levels of it. When you first get into it, there's a lot of work because they don't do the job that you're really hiring them to do at first. And me and Gary find that's one of the hardest things to find a good property manager. But once you do, you find them, it makes your life a hell of a lot easier. So in a deal, when we syndicate a deal, we always look for investors to help provide the capital to buy the property and invest into renovating the units, upgrading the property itself, the common areas and stuff like that. So that's where the actual investor side comes in. Want to go ahead, Gary?
Yeah, so there's a legal structure to this entity, right? We don't just, you can do a partnership. In this case here, it's a syndication. We raise funds through a Securities and Exchange exemption where they allow you to raise funds legally. We actually, have a syndication attorney that puts together all the legal paperwork. We're selling a stock, basically. But if you were to go out and raise money to sell a stock to a real company, that would take a long time, where we need to do this within a short period of time. So we fall under this exemption. There's two different ways, 506B and a 506C exemption, where you can raise funds. And there's rules about how you go about doing that. But basically, it's all a legal structure. It's an operating agreement. The passive investors or the limited partners, as well as the general partners, all are under an operating agreement, which describes the organization, how money is distributed, how the money's raised. So just it is a very legal thing that we go through this process. You don't have to, but if something goes wrong, you want to make sure that everyone's protected and understands what they're getting into. So it's necessary to take that step. I wouldn't avoid it at all myself. So basically, investors make money from the rental income. So just think of it as a multifamily. You've got rental income that comes in. You take that money and you take, a portion out for your repairs, mortgage, taxes, insurance, and the rest of it is your income. Well, very similar in these larger apartment buildings, and all that cash gets distributed out to the investors. We pay out a quarterly distribution to all of our investors. We've not missed that target yet. don't plan on doing that. We work our butts off to make sure that happens. So what that means is that we follow a business plan, and we outline that. We talk to the investors ahead of time exactly what our business plan is, how much money we're going to raise, the cost of the building, most of the cash, well, it's kind of evenly distributed. There's a down payment for the loan. These are very large mortgages. And then there's money that we raise to improve the building. What we tend to do is go in, find a building that's in a great neighborhood, rents are low, needs to be improved, and you want to have some good working capital so you can go in and start executing that business plan, raising the rents, and then that increases the equity of the property. All the rent income gets distributed back to the investors. Ultimately, we'll sell the property, and then all those distributions or the proceeds will all be distributed back to the investors.
Now, a point to make on rental income is one of your ways of making money, but with a large property, there's many other avenues. Our first property we bought, the nice thing, it came with a small parking garage, 15 spots, in Syracuse, where most people park on the roads because there's not a lot of space for parking. We took it that was probably filled halfway, most cases when we bought it, to where now we have a waiting list of 10 people. And we raised the park, we actually charge rent, which is income for all of our investors. So we went from $50 to $70 right now.
We're up to 60 now, but
60, okay.
Actually when we got the property, there was hardly anyone was paying anything. It was just people randomly parking in there. So
we have that for income. The second level is our laundry. We run our own laundry in our properties because we're coin op, they're in the building, we keep them clean, keep them running. People don't want to go out and wash clothes, they don't have to. It can generate a lot of income for your property. And we find a lot of people don't do it that way. They'll let other outside companies take care of them, but they lose at least half the money. And to us, it adds up. It's thousands of dollars a year, we could be losing if we didn't do ourselves. The third thing is pets. Now, we allow pets. The last property owner, and then the property manager that we actually originally hired, didn't believe to press people for paying for pets. They're like, well, they probably have it because they have some paperwork saying that they're allowed to have it. Well, Gary was actually, one of the things we did at our property, put cameras everywhere. Gary was good at watching who came in and who went out. And he would see who came in while they're walking a dog in. Well, what unit they come out of, he can actually write down, call a property manager, ask them, right? So you go down this whole path of weeding through all the people, one way or the other, and you get them all paying rent, pet rent. And our pet rent went from what? Do you recall what it was originally?
we're up to $50 a month right now in
Yeah,
pet
but
rent, but it was $35. Well, right now the pets are in Tip Hill are bringing in about $10,000 a year.
Yeah.
Parking's also bringing in about $10,000 a year.
Yeah.
So
It's just avenues you can find ways to bring more money in for our investors, and why not? Take advantage of everything that's given to you. So we try to squeeze every angle we can within reason. And don't get me wrong, our laundry is probably the cheapest laundry you could use in the area, so no reason why would you go out? You can save yourself some money too. So it works for them and for us.
people are more than happy to find a place that takes pets. So fortunately, we have all hardwood, floors that we refinish and everything. We haven't had any damage from that. Carpeting's another story, so you really wouldn't want to have that. But it's a good way to increase the net operating income, because with commercial property, the value of the property is all based on the income that you bring in. That's why we push to bring the income in and raise the rents. We've taken apartments, 2-bedroom apartments, from $700, we're getting $1,200 a month now, which is more than we had projected in our business plan. But things happen and rents went up, and we kind of took and rode that wave, and that just increases the value of the property, which is benefiting everybody.
Interesting number. When you talk about raising its value by what it brings in, there's different rules of thumbs of what is the number. But typically about every dollar of extra income you bring in at the end of the year is worth about $12 in value. So if you could go from, we were probably those parking spots and pets were probably bringing in a couple $1,000s a year, and now we're bringing in $20,000 a year. That alone, the value of our property goes up substantially. So not only do we make money every day, but it makes, when we go to sell it, it's worth a lot more.
How long do you hold the property typically, and what's the return on investment as an investor?
Yeah, so every property is going to be different. The current deals that we've been working on, they're 10-year deals. So we're going out to getting agency debt, meaning the loan is through Fannie Mae or Freddie Mac, and the terms are generally a little bit better, but there's upsides and downsides to doing that. But we get it's amortized over 30 years, but we take it out for 10 years. So our exit strategy is to sell the property in 10 years.
And then the second half of the question, as an investor, what kind of returns do they look at?
Yeah, so the last couple that we've underwritten, we're doing double-digit returns. It's an average annual return. So what that means is that in the beginning, because we're investing a lot of capital back into the building, the return might start off at 6-7%. By the end of the term, it's 20-some%, right? And a lot of how that works, I'm going to get into the structure just a little bit, is that what our strategy is that we take out debt, we're putting a lot of money back into the property, and after a certain amount of time, our first property we're looking at next year, it's not really a refinance, but you can think of it as a refinance. We're going to pull the equity out and distribute that back to the investors. So within a short period of time, you're going to have a majority of your cash back, and you're still going to be in the deal for the rest of the rest of the years, but most of your money's going to be back in your pocket. So it's a way to kind of ease the pain of saying, well, my money's tied up for 10 years. Really, it's not, as long as we execute the business plan the way that we're projecting.
Sounds similar to a convertible note, convertible debt.
Yeah, exactly. And Fannie Mae allows you to do that. It's a program that they have. So that's why we're pushing the rents to the income, because we go to the bank in year 3 and say, now the property's worth so much. We pull money out of that and then distribute that back to the investors. Everyone's happy. Hopefully they're along with us to go along for the next deal and just keep riding it. So you can actually take that investment and play it again, basically. And I'm doing that myself. I'm a passive investor in 3 deals right now across the country. It's just some. You'll find other deals in other parts of the country might be 5-year deals or something. If you're in Texas or Florida, where the equity is just climbing by the day, right? We started in New York. It's a tough market, but we're managing it, and it's being close to your property is important, especially when you're first getting started. We're investing in Class C properties. We're finding the property that needs the work, where the rents can be pushed up with a little bit of rehab, and that's how we're pushing our income up. So it is a lot of work to do the Class C, and I got to tell you really got to be close to it. John and I are out at the properties. Now that we've got a good system in place, not so much, but it was to the point, like every other weekend, we're out there overseeing construction, making sure that units are being turned and everything else. So, go ahead.
Just 2 questions. Is
Yep.
there a penalty for withdrawing from the syndication? Like, let's say there's a death in the family and the beneficiaries don't want to participate. And the second question is there a way for one investor to buy somebody else out?
Mm-hmm.
Uh,
Your second question answers the first question.
Yeah.
That is in the system where that's how it would work. Basically, if somebody had to back out, we'd work with them and try to find if anybody else wants to buy their share. Most cases, you're probably going to find somebody because they're making good returns. They're like, why not? Or find somebody new that might want to step in. So,
Is there a penalty for
No.
withdrawal?
no, but we just try to frown on that from happening if we can avoid it. If it's not a real reason, right? Because we're trying to. These are commitments we're trying to live with everybody through from beginning to end. And as long as we're doing our job right, we want to make sure if they're happy, why would they leave? So we're not really too concerned about it. But it is something that's a possibility. 10 years, things can happen, right? Yes.
So you issue to the investors a 1099 versus a K1?
A K1, yep. We just got our K1s out, so it's a partnership, basically a tax form. We have a CPA that does all of our accounting work for us, so you do get a K1. If you're investing through cash or whatnot, it's a nice tax write-off. We try to show a loss. I mean, it's just the way depreciation works. What we do is we go in on year 1 and we do a cost segregation analysis. So what it does is you do a cost segregation study. They come in and they take a look at the whole building, because any other residential property or commercial is depreciated over a certain period of time. Well, we're not going to hold it for 30 years. So we don't want to take that incremental distribution, or write down over 30 years. We try to push all that forward. And then we do that so that you get a bigger chunk of depreciation right up front. Better to have cash in hand today than tomorrow, basically. So that's one thing that we do.
So you're an actual partner.
I'm sorry?
So you're an actual partner when you invest.
Yes, absolutely. We have a limited liability operating agreement, and you are a partner in the deal. Absolutely. Yep. A limited partner, and there's a lot of good benefits to being a limited partner. You've got no, liabilities for slip and falls, accidents, insurance claims. Anything goes wrong, the loan. God forbid something happens. It's we take out non-recourse loans. So we're not even liable for the loan. The bank would just take the property back if they thought that we were negligent in not operating the property. They don't want to do that, and we're not going to let that happen. But that's the nice thing about a non-recourse loan. But as a limited investor, you've got no liability whatsoever. That's what the limited liability states right there. So it's nice.
Kind of go through slides as you're talking because some of the stuff is kind of related to it. So I figure
Okay.
we'll move it
Sure.
along.
Okay. Yeah, probably covered a lot of that already. So, yeah, we talked about this a little bit. The sponsors were going to refinance the property, and this is just our business model. It depends on how you underwrite it, right? How quickly you can, get the money back. I mean, the investor wants to get repaid, and however you can underwrite it. We have an underwriting model that we use. It's basically a deal analyzer that we project out all through the 10 years exactly how we plan things to be, how much rent we're going to raise, how much expenses should go up, and we track that, and we make sure that we're keeping, and hopefully we're overshooting that. That's basically how we show that to the investor, and if you trust us and we've shown a track record that we're doing this, then people have confidence. You want to make sure that who you're investing with, that you've got confidence that they're executing the plan. And they have a good plan, right? Not just like, I'm going to go buy an apartment building and I'm going to try my best to pay you back. We actually document this, and we sit down and go through with you exactly what our plan is for raising rents and what our projected returns will be.
Bump it out here.
So cash flow, right? Obviously, many of you in the room here probably have investment properties, right? And you certainly understand that. Generating income, it's a great investment strategy. Other people do other things, right? You got storage, you got mobile home parks. We just happen to be involved in this. It's important, I think, to focus on one asset. A lot of people diversify into multiple different things, but if you do one asset, you can get really good at it. And that's what we try to do, is excel in that. So economies of scale. I mean, that's why my apartments got bigger and bigger, right? I was buying, duplexes and triplexes, and the more people and the income you put under one roof, the better. That's basically, so you can get 50 people under the roof. That's even better yet. So,
Good question.
So you might have just answered my question. I was going to say, at what point is it worth it to syndicate? So you have multifamily, six units, 10 units. At what point did you say we need multiple investors here to put into this one?
Oh, I can answer that. What typically it comes down to is when we use our deal analyzer. Because then we plug in all the numbers and we want to see our returns we're going to receive for our investors, and also what we'll make out of it. So that we're also getting, because there's a lot of work. In the first deal, I think we kind of cut ourselves a little light on the work part of it, getting paid for it, which is fine, but we kind of learn a little bit to adjust. So you got to make sure the numbers all align in a point where it makes sense. And if it's small, it might be we don't even have outside investors involved. We might just buy it ourselves if that was the case. But we're looking for something that's like 35 units and larger. Our ideal spot is between 50 and 100. But that's where the numbers start making more sense when it comes to syndications, because you do need to raise capital. And you might be talking about the low end, you might be talking $500,000-$600,000. At the high end, for these deals that we're looking at right now, $12.2 million in that ballpark you look to raise. So, it's not crazy amounts of money. You're talking about X amount of people, $50,000 a piece to 100. It adds up pretty quick overall. So, all those things are variables in it. But the size is usually the bigger, the better. Ideally, if we could get a 100 unit, we'd be getting one tomorrow. It's just hard to find them too. They're not always out there.
Is each project its own LLC or is there
Yep.
an umbrella?
Yep, it is.
Okay, that's good, yeah.
Yeah, we created a separate LLC for each property.
And do you have like a mission statement of where you invest or what you invest?
It's
Statement or?
It's not really written down, but yeah, we're, primarily focusing in upstate New York.
Okay.
We have traveled, other states close by that we've looked at, but,
So each project stands on its own, right?
absolutely.
A mission based on the
Yep.
Yeah.
Okay.
But we do use our own contractors on both properties, and we have the same property management on both properties. So it's very cohesive. Everything kind of flows because they all know what to do, who to call, how to get it done. And it's slowly but surely get to the point where it's easier and easier on us because they know what their parts are and their roles. And we trust them, so that all weighs into it. And this is some just basic stuff, power of leverage.
Yeah.
Tenants paying down your mortgage.
Similar to any other multifamily property or single-family property, you've got the tenants that are paying the mortgage on it. So, if you want to put the sweat equity in and be an active investor, and I still am. I still have several properties myself. That's, I got rid of the headache ones and kept the ones that I've renovated, and that's where as long as you can spend the time and you've got the talent, you can make your most money at that. But
Right. Goes back to the
so,
tax
the
benefits.
tax advantages. So there's the K1, right? So we have a partnership, the partnership agreement, and our K1. So the K1 basically is, just, how much money did you invest, and what was the, everyone gets a share of the write-off if there's a loss, which,
First couple of years, there's a lot.
you try to. I mean, that's, and it's all just, the government gives you the ability to do that by writing off, depreciating the asset. The longer you own it, all the depreciation's written off, then you start having income, and, you got to put that on your income tax return. So, this K1, you would just give that to your tax preparer, and if you have, whatever income, that would offset your income, so you've got a tax advantage of being able to reduce your tax liability, if done this way.
And in your first year, let's say that you buy a building, you have 10 investors, something like that. Is it conceivable that there's zero income after all the expenses and everything?
We've had losses every year, yeah.
Oh, you mean offsetting what you made?
Sorry?
Are you saying offsetting?
Yeah, so that's very.
It's hard to get to that point, but you're going to get a good chunk, maybe 50%. So, the first couple of years, it helps kind of offset it. And it depends. It depends on how many things we're investing. If we're putting in a lot of renovation up front, which we end up doing, but some jobs are more expensive than others, it will, the first few years, kind of be a bigger chunk, then it kind of slows down after that. But it's a nice, because it's a bonus that you can't really account for. You can't really say, I'm going to make X amount of money that I'm not going to be taxed on because I have this write-off. So it's one of those perks that we can't really.
What they do is they go in and they get all the refrigerators and all that other, stuff that doesn't have a 30-year life, right? And they depreciate it like it should be in, 5 years or whatnot. And there's a lot of other components, parts to a building that don't have a 30-year life.
Right.
And, they just push all that straight, up forward to where, you've got a pretty good depreciation to offset the income.
And the inflation hedge that's on here, it's one of my favorite things because it makes me happy when I think about it. You got a large property, you have property management, and you're always pushing them to increase rents a little bit every year. If it's 2% or 3%, you get people on the routine where they know it's going to happen, they don't complain about it, and you're always increasing the income coming in, but you're also putting more value in the property. So it's giving you that inflation hedge overall over 10-year span. If you increase rents every year, even if you don't do major renovations, the value has gone up substantially because of that rent going up, and plus you've made more money. So it's a kind of one of those beautiful things that it just works, and it works better in that situation like a single family or double, because you get very intimate with those people, and at some point you're like, all right, I don't want to, you're a good tenant, right? And you feel very comfortable, and you sit back and kind of let them live there and let it be. Apartments is different. You're disconnected, and you just you don't want to beat them up with high increases, but you always want to take advantage of what's given to you. So, and we try to all the time. It works really well.
Are there investment minimums?
Typically 50,000. Yeah. Just because you don't want to have too many people involved. And any one deal, it just becomes more complicated.
Yeah, that's pretty typical throughout all syndications. You'll see $50,000 or $100,000 is pretty typical. We've pretty much stick to that. Just, it's like John was saying, generally the deals we've been doing, we have like maybe, 10 investors in on them. So it's just.
So your favorite part, Gary, breaking it down.
Okay, yeah. So, first thing, how to get into it, determine your investing goals, right? I mean, do you have, extra funds that you are, maybe you're flipping properties and you've made a bunch of, cash and it's, just kind of sitting there, or maybe, you don't have anything quite that you're, investing in. It might be a goal to have another stream of income. So you take and, do a little passive investing with that this way. So could be a goal. It's a goal of mine. One thing I did, and you can invest through I was employed for, several years through a company, and I was laid off. That 401k that I had became something that I could now use to go out and invest any way I wanted to, because it was no longer an employee-sponsored plan. Some companies allow you to do this. You just got to ask, if you've got a 401k with a plan, can I do this? And what you do is because if you're like, say, through Fidelity or something like that, they typically won't have any kind of vehicle like, to invest in through apartment syndication or anything like that. You've got to take the money from that and move it over to a self-directed IRA. Maybe you've heard of self-directed IRAs. And there's no tax consequence in that as long as you don't touch the money. You just take it from here. There's many different custodians that you can work with to do that, and then they will then invest the money for you, because it's an entity if you're investing through an IRA, or a /401k. So there are ways to look at getting the money to be able to do that. I kind of wish I had done more. I'm actually back with the company that I was let go from, and I wish I had taken more, but because I left kind of half of it there, and I took and invested the other half passively, and it's doing a lot better passively than through the stock market.
And even through all this, through COVID and everything else, there's no change in what happens. They're still renting them out. You do have some people that aren't paying. You got to move out, but overall, people tend to pay. They want to have a roof over their head, and as long as you have a property big enough, you could have 10-50% vacancy, and you're still going to bring enough income to make money. So there's a lot of structural balance there from having those numbers. It really, I think there's a comfort to it. It's funny, I talk to people that don't know anything about this. I always ask them, I go, what's the more risk, buying a property of 50 units or buying a property of 500 units? And they'll all be like, well, 500. And you're like, it's the other way around, because you have the numbers. The numbers work in your favor every time. And if you can buy a 500 unit over a 50, do it every day of the week, and you'll win every time. And it's a mindset thing, but numbers are your friend here.
We got about 15 minutes, so why don't we pick it up a little bit, the pace. We'll show you a little more information, and we can ask some time for questions still. So,
all right.
Yeah.
So your next step, you're going to be finding an investment opportunity that fits you. Now, that could be multifamily, it could be storage, it could be whatever, but also it could be the syndicators that you're maybe working with. Knowing you're comfortable with them, you have conversations with them, what their plan is makes sense to you, the numbers that they're projecting are good numbers, all the things that would make you comfortable and sleep at night well. So part of it is finding that opportunity, and it might be with just like a group like ourselves or somebody else that's similar that you find just fits you well, So that's part of the process of finding your path and your investment opportunity. Gary's favorite thing, reserving a spot.
Yeah, so when we have a deal, we're constantly looking for apartment deals. We have we try to collect people's information, networking. People find out, who you want, that might be interested in investing. We'll give you business cards, and then when an opportunity comes along, we'll reach out to you and present the deal and see if it's something that you might be interested in.
Any kind of tiered approach if you're an accredited investor?
We don't, so there's the 506B and the 506C, and we've been raising money through the 506B, which means we can raise money up to 35 non-accredited investors, per deal. I don't care if you're accredited or not. I don't need to know. The rules behind that, though, is I can't advertise. I can't throw it out on Facebook and say, hey, I got a deal. Who wants to come in? That's a 506C. where people have to be accredited and you have to, go through a process to show that you are. In that case, and that's what you hear on the radio a lot, advertisements, people raising money. You've got to be accredited, meaning you have to have, show a certain net worth to be able to invest in that. We don't require that in the deals we've been doing, but yeah.
When you're looking for like investor, is there a certain like equity cap that you can give them? Is there like a certain amount of equity you can give?
Oh yeah, absolutely. You get an equity share, your percentage ownership based on your investment. If you invest.
Is it like, can you offer them more equity than you have in that property, or did you ever do something like that? Like if they came to you with like a big amount of money?
Let's talk after the meeting because you have an interesting question now. So, there's different scenarios when it comes to investors and how many you get, but we're don't, as a partnership, we don't have the majority of the ownership of it. We only own a portion of it. So typically, even any of our deals, we're only 20th or a third of the deal that we might own overall, and then the rest is for the investors. So that ratio changes on a deal basis in our investors. So yes, to answer your question, yes, we could. Want to move along on this?
Yep, go ahead. So then there's the private placement memorandum. This is the document that's put together by the Securities and Exchange attorney. They're pretty pricey for what they do, but it can be anywhere from $10,000 to $15,000 to put this document together. But it's basically the agreement that says, hey, you understand the risks as the investor, and you sign it. And then it also has a subscription agreement in there, how many shares you're interested in purchasing. But that's what that is there, the private placement memorandum for PPM. Next step there would be to send in your funds. So once we've pretty sure that the deal's going to go forward, we'll start raising the money, the capital on this, and we'll meet with investors and tell you when we got to have your money, typically before we close. And then you're in. So basically, once the deal closes, the operating agreement is all signed, and we send out updates and quarterly reports and emails, kind of let you know what the property's doing, how things are going, and try to keep everyone informed as the progress. Great way to enjoy the benefits of real estate without having to be a landlord, because being a landlord sucks. Yeah. I hate it. Sometimes it's
How much
just.
time do we have? 10 minutes?
Yeah.
Do you want to show the example deal just to kind of
Yeah,
break into there?
we'll just show you a few things. Just basically, I don't know, just some more things here. Passive investing information here.
I think you kind of covered most of the stuff already.
Yeah, I probably talked over most of it there. That's the way I am.
Let's move on to.
So here's an example deal. This is actually a 37 unit that we just bought in June, right? So just an example of what this looks like. It's value add, meaning that we've identified that we can raise rents, we can turn the tenants over and increase the value of the property. They were asking $2.1 million.
Oh, sorry. We'll touch on the button.
And it was a value add opportunity. So basically, that's the way you make money, right? Is to, if you go out and buy an A-class property that's all, built up, it's all ready, you're not going to raise the rents very much. You're just going to make a very small return on it. There's not much you can do. It's a nice, safe investment. That's somebody else's strategy. Ours is to go in and really pound it out and make a good return. So what we'll do is we'll get the, income and expense summary. Basically, this is telling us, how much they were asking, the expenses they provided to us, vacancy information. This is probably from the realtor. They tell you, what they're thinking the projected rents are. Just a little bit of underwriting information.
The value they're asking for you to pay is off what they project it's going to go to, not what it's actually doing. They always want you to pay what it's going to be, but then always you got to fight that battle, and you rarely would ever pay what they're asking, but they try to make it look as pretty as they can.
This is an important number. This cap rate. It's completely subjective. Somebody will tell you the cap rate around here is 4%. The lower the cap rate, the higher the value of the property. There's no way the value of properties around here is a 4 cap, but broker will tell you that. So you kind of got to come up with what have other things sold at, and that's the number you divide into the net operating income to come up with a value, which is the next slide he's got. Well, no, next one is just a rent roll. Verify your rent roll.
Right.
Add them up. Make sure you know what you're looking at there. see what the average rent is in the neighborhood. You know, we were looking at average rent was around closer to $700. We went to Renometer, and you know they're getting them up to $1,000 for a 1-bedroom. So we saw that we definitely could raise some rents there. Yeah, this was just some pictures they provided to us. This is the 37 unit, just pictures of the units, nice hardwood floors, buildings, you know, built in the 30s, and you know, good bones, good structure, good solid buildings, very typical for the area that we bought in. And this is our 5-minute valuation. So within a few minutes, I can tell you what the property should be worth. Take a look at the rents, give it a vacancy rate, you know, 10%. Come up with your, you know, your annual income, your expense ratio. If you're paying heat, we typically do 55%, which on our buildings we're paying the heat for the tenant. Could be 50% if you're not. And then you come up with your net operating income and divide it into that magic number called the cap rate. And we came up with a valuation of $1.7 million, 1.68, and we ended up paying 1.75 for it. So.
You know, it's funny, this tool is as simple as it is, and it's not really something you use to base off what you're going to buy it for. But most cases, when we look at a deal and we do this first, and then we sit there and take the spreadsheet out and fill all the numbers, everything, and then we do our research, like find out what they're actually paying against what they're telling you, and the numbers are within like 2% of what that number gives you. So it's good for us up front to kind of do a quick evaluation, say, is this property even worth our time? Because, like, say, for example, right there it's 1.768. He's asking 2.1. He might not be willing to come down, right? So if you could talk to the realtor and go, you know, the broker, say, hey, is there any room? And he's like, no, he's not moving. He's not budgeting. All right, well, we're definitely low enough where it's probably going to insult him. So we'll just walk away or come back to us if he doesn't sell it,
And
right?
we did.
And that's kind of what happened. The first time around, they didn't want to take it. Then he was going to sell it to somebody out of New York City. He was going to throw him even more money than he was asking. And then by the time he went through due diligence, he probably dropped it to, you know, who knows, even probably lower than what we bought it for. And they backed away from it. So then they came back to us and they said, let's talk. So, but the 2-minute analyzer here, it does help. Just a quick kind of a read on the building and what it's worth. And it's not hard to do. Usually do it on our phone with our calculator. So,
Adam?
So looking at this at a 7 cap, which is okay. It's, you know, the property looked nice and everything. Right?
Yeah.
7 cap is reasonable.
mm-hmm.
That being said, what were some of the key factors that you said, hey, this has potential to be here, such as, right? Obviously, the rent increases that could be in place.
Right.
Maybe bad tenants that could be displaced.
Right,
things
correct.
Like that. What were some of those key factors that you looked at for your value add?
So those are probably the first two things you said are right on. But, you know, we see the clientele there. We know we can upgrade what's there. There are, you know, issues and problems you see when you do due diligence. You walk every unit, so you get to kind of see how they're living. You see, you know, people that are coming in and out of the building when you're there. So of course the tenant base, changing them out. But one of the things like this property is almost very similar to our first property in Syracuse. It has the same kind of bone structure: hardwood floors, plaster walls, high ceilings, big windows. You know, it has all the potential to be beautiful. We know from our first property, so we already have an example of what we can do at what cost, and knowing what the rent's going to go up to, does it make sense there? And of course, it applied, so, you know, it's a cookie cutter from one property to the second property. So we kind of use that for a bar. Can we do it? Yes, we can raise it here. Those are probably the big things we look at. Then we see anything that might be missing. You know, do they have laundry on the services there that we could put in there? Are they charging for pets? If they're not, you know we can charge for pets, and we'll get the money out of, you know, we'll make a decent income off of that. Charge parking. There's a parking spot in the back of the building that is not being utilized, and we could make it where we start charging for that too. So all those things weigh into, we can say, all right, you can add these values into it, and over the next 10 years, it's going to bring back X dollars for us. So yeah, all that stuff weighs into it, and we always look for whatever there is opportunity.
And at both properties, we've significantly improved the common areas. All new flooring, all new carpeting, all new LVT, all new LED lighting throughout. The latest property, we did all new, brand new entry doors that are. He can open the property now from his phone, let people in. But so yeah, we do a lot more than just the apartments. We want to improve the building, new awnings, you know, just give it a whole new, fresh appearance. So different people have different set of eyes want to come and live there.
Just throwing up here, if you're interested in learning more, here are some names you can look up online that are multifamily syndicators. And they all have different avenues how they do it. They're all great people. All these guys we've met, except for maybe Robert Helms, but everybody else we know and actually are friends of. But these guys are doing $100 million deals. I mean, they're big. And they do a lot of training, they have books, they have podcasts. I would suggest you guys want to learn more about it. Just look up the podcast on Multifamily and find any one of these guys and just listen to a few of their podcasts. And if you are interested, I guarantee you'll be hooked at that point. You'll probably be digging deeper and deeper in it because the potential's there. And numbers make sense. That's the way I look at it. All the numbers made sense when I looked at it up front, and it's kind of why I just turned my path to what I was doing into multifamily. Way to make more money.
So one good thing I guess I would just stress about our partnership. John and I work very well together. We've been doing this now for almost 4 years. I'm more on the spreadsheet end of things, the numbers, working with the property manager. John's he's a commercial building expert. I mean, just everything. We've boilers, we've had all the building stuff there. I mean, and he's good with the underwriting too. In fact, he likes it better than I do. As far as you take a building and you analyze it every which way, how can you make money on it? What can you do? He loves that. Where I'll work with the banks and I just kind of handle all that stuff there. So it's good when you have a partnership and you work with you find out what everyone's strength is in the business.
A good way of putting it too. Gary's good at the practical things. I'm good at looking at the potential of things. And the two of us together kind of meet in the middle. We kind of very good, relationship, talking out through things and common grounds, figuring out, where I want to put in, 4 new doors. He's like, well, do we really need 4? Or do we need 2?
I'm the miser.
And how much money that more is? Let's put that somewhere else. I'm like, all right, fair. Which is nice because sometimes you want to compromise. Sometimes you shouldn't do something more, or maybe even like Gary's like, we shouldn't do that. And I'm like, no, we should do it. He's like, okay, it makes sense. Let's do it. And then after we're done, we're like, that was a good idea. It worked out well. So having somebody, we talk probably daily minimum, if not 2 or 3 times a day sometimes. So we're always working together. So this is a business too that partners are everything. You can do it yourself, but you'll go a lot farther, a lot quicker with somebody because they'll always have a different perspective than you do that will make you understand and maybe feel comfortable with what you're doing.
It's big numbers and it's a lot of risk, and you need. It's good to have someone that you can bounce ideas off of. I tried it myself at first. I went to Michael Blank's, seminar down in Reston, Virginia, and I came home and I was going to just do this, and my wife and I got her all dressed up in all of her finest jewels, and we went out and looked at a few, and she's just like, don't you got to tell them we don't really have $2 million? I'm like, it's not the way it works. And I put an offer out, my first one, and I just wasn't confident that it's good to have someone that you can bounce ideas off of.
Yeah.
And
right. It's sounding board. Sometimes it's the motivator, vice versa. We're always pushing each other on stuff, so it kind of helps. But we're always looking for good people who want to get involved. We love to teach people more about it. It's a great business, and you can do it anywhere. You can do it in your backyard, or you can do it in bigger cities. And we have friends that do it all over the place.
So that's what we do. That's passive investing. We look for investors. If you have any interest in that or want to learn more, got some business cards, you can give us a call. We more than happy to talk to you and explain what we do. And so.
And it's as simple as we kind of broke it down here. I know maybe it wasn't simple, but it's step by step. It's that easy. It's just get in a recipe, you follow it. You get someone like Gary or people around you can work with, and it's just a matter of working through the process. Up front, both of us probably had some big doubts that we could do it, but it's like anything, you just got to keep chiseling at it. And there's a lot of opportunity out there.
There's a lot of struggles, a lot of goods and bads. We've had property managers, and we finally got a property manager that we're very happy with now. That's managing both properties. We had one for 2.5 years, and they were just. The book work was good, but they were doing terrible maintenance work for us. We had our contractors were pulling them off work to go do stupid stuff because we needed it to be done properly. And we hired a property manager on the new property, and they were just like, as John described it, a nice flashy car with sitting on blocks in the street. They just couldn't do anything. They were just, boy, did they wowed us with all of their capabilities. But I need reports. I need monthly reports, and I beat them up over it. I need monthly reports. I need to see what's going on. I want to see all the rent income. I want to see who's paying, who's not paying. I want to see your expenses. And I catch stuff all the time. I mean, I'm an eagle. That's just what I enjoy doing that. So, in fact, John and I were talking about starting a little business, just teaching people that maybe are into this how to manage the property manager, because don't just assume that they're going to do a good job.
Right.
Because that unit's going to go vacant. We've had units vacant when we first. The property manager didn't even know the place was vacant. The tenant moved out. And you're like, that can't happen, So yeah, we're right on it. Don't let the place sit for a month, and then they'll get someone in to clean it and maybe do a half-ass renovation job. We're right on it. As soon as I know that person's moving, get in there and let's start showing it. I'll get our contractors in there, and you just got to keep executing it. So that's how you make the money. Is you got
quick difference of what we had before to now was before somebody might be moving out, and they might move out say in the month, and it might be 2 months before somebody moves in. Like best case scenario. The new property manager, somebody's moving out, they already have somebody signed to move in at a predetermined date, like already. It might be a month later because we got to do renovations, or it might be the following, like 2 days later, so we can clean it and get it ready for them. So, it's hard. It sounds easy enough to go find a good property manager, but it's a lot of work because, like Gary said, they will tell you they're the best. At the end of the day, their performance tells you how good they really are. And Gary's great at watching that stuff, but we also, one of the things we invest in both our properties, and we'll do it every property, is a good camera system. So we can see what's going on. Like we have cleaners that come in and clean twice a week. We know if they've been there or not. If the plowing guy, it snows and they didn't plow, we know they didn't plow. We're making phone calls. And we can do that from anywhere.
John's put in the camera systems. Yeah. I mean, he's good at that. We got him right on our phones there, so we can see what's going on at the properties. That's important. The very first thing we do is put camera systems in. So,
good. Time?
Yep.
5?
We're there.
We're there.
We're good. We're wrapped.
Awesome. You guys are on. Thank you. Thank you, guys. Appreciate you guys.
Sure.